a small portion of your income should go into retirement kitty from day one.
Is inflation really the biggest invisible enemy in retirement planning?
People understand inflation. That is the problem is they are not able to actually grasp that it can be so high. So it is financially independent, retire early. Fire. Living extremely frugally. They talk about saving something like 70% of their income. Okay, for a long period of time.
The whole interest rate scenario has also changed, and I think that also needs to be taken into account when you're planning your savings, your retirements, your life cover, everything.
I mean, we will have to actually draw that fine line between doing well today, spending for what you want to do in life today, and also saving for your tomorrow.
What does an ideal retirement plan actually look like?
So the lack of purpose actually is what they see in retirement. I mean, not really realizing that buying a pension plan alone is not going to ensure that your retirement is fine.
We also leave a certain part of our income for retirement, and we have to start early. One medical bill, can be really a multiple of your monthly expenses. It can be, as high as your annual expense, in fact.
The amount of money that you are able to save till 50 is the same or more in between 50 and 60. So one of the things to take care of this eventuality, is that life insurance.
The best time to plan to do your retirement investment, it was yesterday.
Correct.
And the second best time is probably today, but not later than today. Hi, and welcome to Depend on Insurance, Depend on Us. I am Jyoti Vaswani, Chief Investment Officer at Canara HSBC Life Insurance. Today's episode is all about retirement. Not just the financial preparation, but the emotional and practical rewiring that comes with it. When done right, retirement can be the most secure and purposeful chapter of your life. Joining me today is one of the most trusted names in financial advisory, Mr. Suresh Sadagopan, founder of Ladder 7. Together, we'll break down how to retire with clarity, confidence, and a strong safety net. Welcome, Suresh.
Thank you.
Okay, at what age should one ideally start doing retirement planning? Is it ever too late?
No, it is not too late. I mean, a lot of people have not started in their 20s and 30s. So, that's okay. We'll have to work with what we have. So, if somebody is in the 40s and they are, at least at that point, they are understanding that retirement planning is important. Then what we can do is, okay, from that point, what is that you have to put aside? One of the things that they can do is, first of all, of course, start your regular monthly investments. The second thing that you can do is you can prioritize any bonuses, ex gratia, or any other payouts that you get. You can prioritize that over other things, and you can actually build a retirement kitty. And if you know that you are slightly late, no problem. So you have been living it up, right, for the past 20 years. Now you probably can delay buying your car by maybe a couple of years, and that amount can actually go into this thing. So there are ways and means of doing that. The other thing is, you really look at what are the expenses today. A lot of people again overestimate their requirements in retirement. They tend to think that if I'm spending 70,000 or 1 lakh rupees today, for example, they tend to think that I'll continue to spend the same amount, which is not the case. What we have seen practically is that just after retirement, you tend to spend similar amounts. But after 4 or 5 years, and because they tend to travel a lot and things like that, just after retirement, you get that freedom, right? So you tend to travel a lot. But after 4, 5, 6 years, it all comes down to a much more mellowed down pattern. And in that pattern, the amount of money that you spend, in my opinion, comes down by 30% at least. Because you don't have to spend on conveyance, your lifestyle and all that, all the expenses which you require for furnishing your house and a lot of other things are already taken care of. You don't buy as many clothes as before. You don't go out for your entertainment and eating out. You will go down, but not as much. So expenses do come down. So what one has to be cognizant of is the medical thing. Their health related thing can go up. So all these factors we will have to actually bear in mind while we are planning for retirement.
And absolutely, one medical bill, can be really a multiple of your monthly expenses. It can be, as high as your annual expense, in fact.
Correct.
So I think that obviously, and that those things really happen more when you're older.
Yeah.
Even if you are taking care of your health, these are things which are inevitable, and you need to provide for everything. So yes, I think that's a very important point that you're making here. So let's talk about some thumb rules, So recently I met up with a, team member of mine earlier, and just 35, and he was telling me that, ma'am, I want to I'm planning to retire by 40, and there is this concept of fire, and I'm kind of following that. So could you, really explain if fire kya hai? I mean, what is exactly this fire concept?
So this is something which we tend to hear a lot these days with young people. So it is financially independent, retire early, fire. So the concept goes something like this, where people want to do something meaningful after they retire, and people also do not want to take a very stressful life, I mean career wise, and they want to put a full stop early on. They may want to continue doing certain things which can bring in certain income, and they may want to pursue a more relaxed life and pursue their hobbies and other aspirations. So this is the theory, right? So now when it comes to actual practical aspects, I mean the aspirations are many, and I would rather put it as sky high. So when the aspirations are really like that, people who are willing to work till 60 themselves are struggling. I mean, to meet all the aspirations and also to ensure a comfortable retirement. Now, if you want to actually truncate that earning period to just 20 years instead of 40 years, you have to meet the retirement corpus. I mean, your retirement is no longer 25, 35 years.
Yeah.
Now it is probably 50 years or somewhere around that. So you have to save for 50 years of existence, I mean comfortable retirement, and that period comes early on. So you have only 20 years to do that, and in that period the goals also would not have been met. Had you superannuated at 58 or 60, if you have children, your children would have most probably done at least most of the education. At 40, no, probably they are still going to be in early school. So it is actually very, very challenging. So I'll tell you how these people want to make this concept work. What they say is living extremely frugally. They talk about saving something like 70% of their income, okay, for a long period of time. So that means extremely frugal existence. So this is not going to work for everybody, because it is not one person thinking of fire. Okay, it is the entire family which has to buy into this particular concept. You may be all gung ho about it, but what about the family? They want their whatever they are seeing around them. They want all those things for themselves, and I would not say I would fault them at all for that. So that is a normal thing which they are seeing. So now, if first of all you have to convince your family. The second thing is, I mean, quite apart from the concept of whether you can accumulate that money or not, the more fundamental question is, if you are putting that your first 20 years is meaningless existence, or you are doing work which you are not really happy, are you okay with doing meaningless work for 20 years? So I mean, that's the fundamental question that you will have to ask yourself. So if you frame the life as 20 years of meaningless work, and after that maybe 30, 40 years of real good work, I think the framing itself is, in my opinion, somewhere wrong. I don't have any problem about people retiring early, but if you are not enjoying your work and that is why you want to retire early, that is wrong.
Oh, it may also be because if they want to go the entrepreneurial way, they want to have a financial security for the family, and then get into that kind of a venture, because that will also take time to pay off, and the success is dependent on a lot of factors, but that's where their calling is, and probably that's one of the reasons that they do this.
So let me come in on that. So suppose somebody wants to start up something. I'm not sure whether 40 is the right age to start or 42 is the right age to start. Okay, and if you have an idea and you have been germinating that idea, that you cannot really germinate an idea for 8 years or 10 years. If you have an idea 6 months, 1 year, 2 years, I mean, you'll have to start somewhere. That is number one. Number two, one of the things which people who are pursuing fire tell me is that they want financial security. That definitely they say. And if you are also talking about entrepreneurship actually, I mean, it's a minefield. I'm not saying entrepreneurship will not work. But again, if you really look at any startup or any entrepreneurship, it is 1 in 10 which succeeds, probably 1 in 50 which succeeds. So you are going to put in a lot of money and a lot of time and effort in that. So people want to live in a relaxed manner. One of the things is financial security. One of the things is also they want enough time to pursue what they really want. Now if you bring in entrepreneurship into that, any entrepreneur, I mean, talk to anybody, I mean, they will work between 12 and 14 hours or maybe 16 hours,
Absolutely.
7 days a week. So that is how enterprises are started. So are you okay with that? I mean, for that, first of all, for 20 years, you are living a very frugal existence. After that, you are going to really put in some of your money, and then you are going to work 12, 14 hours a day for the next, for 7 days a week and for several years. I mean, people will have to really understand what they are getting into. I think a lot of times fire is a very, very nice concept which people, it bites them and they feel very good about this whole thing. People will have to really examine whether it is for them or not. My point, which I keep telling my clients, is every day counts. I mean, if you are going to live a wonderful existence only after 20 years, there is something wrong. What about today? I mean, will you be there for 20 years? I mean, do you know you will wake up tomorrow? You don't know, right? So then why are you talking about 10 years hence, 20 years hence? So it's meaningless to talk about that. My point is, you have to bring in that quality that you want in your life today and make your life meaningful today, rather than looking at some future point, maybe 15 years down the line, 10 years down the line, and hoping that it will turn out to be great.
So basically, we are saying that people should ensure that the fire doesn't burn their lives today for tomorrow.
Absolutely.
That's the great
concept. The thing.
They
They have to really examine this concept of fire and not get taken in by this, by how sexy the concept is looking, and dive into that headlong. They may actually get scalded.
Absolutely. So let's talk of some rule of thumb for investing, and there are so many approaches out there, and what are some of the key principles or rules of thumb which people should follow, when it comes to building an investment portfolio, especially when they plan for retirement?
So I think we have heard about this 50, 30, 20, that kind of a rule, where 20% is basically for your investments. I mean, these are rules of thumb, so we will have to keep it that way. If you really look at how much people are saving in India, if you look at it, largely it is about 30%. And that 30% also which we are saving, we are spending on the near-term goals and the other significant goals which from the family point of view are important, whether it is a vacation, whether it is a home, whether it is children's education and stuff like that. So this 20%, I don't know where it comes from, whether this is significant, I don't know. I think I would stick with 30%. 30% I would say should be not the lifestyle expenses, which normally is thought to be like that way, but 30% should be the savings and or investment, savings and investments, and 20% should be the lifestyle and 50% should be the, see, these are all, I mean, rules of thumb, ballpark figures. So probably at an early stage these things can work, but going forward what will happen is the amount of money that you spend on a monthly basis, the regular expenses, will be a small and insignificant portion of your overall earnings. Okay, lifestyle expenses will be there, but the basic grocery and other conveyance and these kind of things typically tends to be a smaller fraction of your income. So let us keep this parked in our mind somewhere. So not 20%. Again, I would want to tell the viewers it should be 30%, not 20%. So that is the problem with the rules of thumb. If you just go with the rule of thumb, you may not reach your target. But at least, okay, 20% is not bad. So to start with, you can probably look at 20%. So there are things like that. The only main thing which I would say you should not really forget is save for retirement, don't touch that kitty. So these are two rules of thumb which I would say at least 10% should go, ideally speaking, from the early years onwards. Like I mentioned earlier in the podcast, at least 5% if you can't do 10%, but 10% is a good number. I mean, those are the rules of thumb. But again, when you come to a financial planner like us, we will really look at what is your lifestyle, what are your goals, what are you earning, how long are you planning to be in that phase. and things like that. We will be looking at all those things, and then accordingly we'll craft a portfolio. Accordingly we'll tell you how much you need to save so that your retirement is taken care of. So rules of thumb is good, but ideally
So rule
plan.
of thumb would be that, when you're young and you have a lower salary, probably you have a lower savings rate, but as you go up in your career and your income rises,
Yes.
your percentage of saving should move up from 5, 10, 15, 20 to 30 as much as you can take it up, because rest of your needs are taken care of by your higher income. So I think as you grow in your career, the percentage of savings in your portfolio should be much higher, is the thumb rule then,
Yes.
from what I
So
can gather.
I'll bring in a very interesting point here. For most people in their careers, the period between 50 and 60 is a very significant period. I'll tell you why. Because you are at the peak of your earning period at that time. And what you will earn at that time can possibly, a bulk of it can go into savings. Because a lot of your lifestyle expenses, I mean, what you want to create in terms of home and doing up the home and things like that, are all kind of taken care of. Probably your children are out of school, probably into college, for which you have already planned. Okay, so the amount of money which is available as a discretionary spend or investment is actually significant. So what we have seen as financial planners is that the amount of money that you are able to save till 50 is the same or more in between 50 and 60. If you have been able to save, let us say, 2 crores in that period, the amount of money that you can save in just 10 years, 8 to 10 years, will be a similar amount. That is what we have seen. So 50 to 60 period is a very significant period from the point of view of a person's lifetime. I mean, in terms of the
I think
savings.
that's why people think of retirement planning also at that point in time, because they have enough surplus and they have all their needs are taken care of, and that's when they start thinking, okay, now I have enough surplus and I can still plan, and I'm closer to my retirement, so I need to. Probably that mindset may not be right, but yeah, that's how it currently is.
True. So a lot of people do that, and I mean they get to a reasonable corpus, but had they started early on, and then they also do this, then they'll be extremely comfortable.
Absolutely, absolutely. There are a lot of myths also about retirement planning, so let's just try and burst some myths as well. Let's do some reality checks out here. So myth number 1, I think, is I can just rely on my employee provident fund for retirement. That should be sufficient to take care of my retirement needs.
So even in the best case scenario, if you have not touched your employee provident fund and you have been earning well, and you have also probably topped up whenever you can, even in that scenario, most probably that will not be enough as a good retirement corpus. I mean, it will definitely go a long way in terms of augmenting your retirement corpus. But by itself, I don't think EPF alone is good enough. EPF and gratuity and any leave encashment benefits and any other retirement benefits can be a significant amount, but at least in our experience, this amount is, though significant, it is not good enough to take care of your retirement entirely. You have to do things outside of it. It has to be some investment corpus, it has to be maybe some pension corpus, maybe NPS or anything else. It is absolutely required. And of course, a lot of it is a factor of your own lifestyle, your own expenses and your own goals, because a lot of us tend to think that there are goals only in the pre-retirement period, which is not true. I mean, in the post-retirement period also there are goals. Post-retirement period, the goals are something like travel. A lot of people want to travel, at least in the early phases. People want to give gifts to their children and their grandchildren in their retirement phase. So, I mean, from their point of view, it's a goal. They want to leave a legacy for their children. So that is also something that they really look forward to. They want to lead a comfortable living, and they don't want to count the paisa and rupees at that point in time. So that is also, I mean, it is not a real goal in that sense, but they want to be in that place. So we cannot say there are no goals. And a lot of people also want to do philanthropy. I mean, they have lived their life and they want to leave a legacy for the society. They want to do something. So, I mean, these are goals. These are some of the goals. And other people have other goals as well. So, we have to take care of the retirement period properly, and the corpus has to be appropriate for whatever goal they have.
Yeah. So it's actually, people look at it like it's the end of something, but actually it's always a new beginning and beginning of something else. So that's how you should look at life and retirement, and it's not the end of anything.
Yeah, it is not the end of anything. I mean, in fact, it's the second innings. That is how I put it. I mean, second innings is second innings. What you can actually make out of your second innings is entirely up to you. I mean, you can always say that, oh my God, okay, now I'm retired, I'm old, and things like that. But another way of looking at it is, oh my God, I have a new tomorrow to look forward to, and I have my 24 hours with me.
I'm
what
free.
can
I can do anything that I want.
Absolutely,
it's freedom.
I can do absolutely anything. I have that freedom. I don't have to be worried about the money tomorrow. Money is there.
Absolutely.
Now, what can I make of my life to make it far more meaningful and well lived? So that's another way of looking at it.
So it's like you should not retire from something, you retire to something.
Absolutely.
And I think that's the key difference.
Retirement should be enriching. It should be enjoyable. So, energizing. So that is what retirement should be, ideally.
Right. So another myth is I can plan for my retirement later on in life. I have all the time in the world to do that.
Yeah, so we have talked about this earlier. A lot of people are in that boat actually. But I mean, the later you postpone it, the harder it is going to get for you. And probably you may want to depend on your children. I mean, you will be forced into that corner, which probably even you would not want to be in. So, or you may have to really cut corners at a later point in time. So, simple thing, there is no fix for this. If you are going to postpone your retirement to 40s and 50s, there is no fix. I mean, then you will have to put a humongous amount of money in your 40s and 50s. If it is possible, that's fine. If it is not possible, you have other aspirations and other requirements for your money, then what will you do? Then it becomes difficult.
And a third myth, I think typically more so in India, is that my children will take care of me. So while at one point in time I think that used to be the case, but do you really think that's still the case?
See, I think a lot of my clients really don't want to be there. I mean, when we talk to them, they may be in their 30s, early 30s. They are planning for a child, or they already have a very young kid. I mean, they are very clear. Most of them are very clear that we want to stand on our own 2 feet. We don't want to depend on my son or daughter. In fact, on the contrary, I want to give whatever is possible to my son and daughter as much as possible. I don't want to depend on them. So that sense of independence has really creeped in today. So calling children as one's retirement plan today, I think that no longer exists. Okay, and the more fundamental things is, I mean, a lot of people say that, oh, in our generation we used to take care of our parents. In this generation, things have changed and children will not take care. See, I am not cynical like that. So I am saying that, I mean, everything has changed today. Okay, children are struggling in their own life. I mean, it's a different world that they are living. We have lived in a different world. They are living in a different world. So why do you want to put the onus of supporting you in your retirement when you could have done that yourself?
Absolutely.
So that's not the right thing. I mean, why put that burden on them?
Absolutely. Totally agree on that. The other myth is I don't need to worry about inflation because my expenses are anyway going to decrease once I retire.
Inflation is going to be there. I mean, we cannot really wish it away. People say that inflation is a number which goes up and down. That is true. I mean, we can wish for it to come down. But it has been there, stuck at say maybe 5-6% for the past maybe 20 years. So on an average it is 5 to 6%. Okay. So I have no crystal ball to say that tomorrow it will come down to 1 or 2%. So I would want to think that inflation will be in the ballpark of maybe 5-6%. And I would want to plan for that. So if we are going to ignore that fact and we are going to plan saying that, okay, my expenses today are X and maybe it will be 1.2X after 10 years. So that's a foolhardy way of actually going about planning. So you have to be realistic. You cannot assume certain things just because today you want to spend your money.
Absolutely. And if inflation comes down to 1-2%, the interest rates will also have fallen by then to 3-4%, and therefore your earnings will also be lower, which will adjust to the actual inflation.
Right. I mean, so in that context, I want to actually talk about one more thing. A lot of people tend to think that I want to invest only in FDs, or I want to invest only in safe instruments. See, that, like you rightly pointed out, in our fathers' times, that would have been possible. They used to get 14-15% as interest rate. That era is not on us today. So we are talking about 7-8% at best, and we have also seen situations where we earn 5.5 and 6% also in the past. So it is absolutely essential for us to be willing to take a certain level of risk. So that is why some amount of equity or gold or real estate or some other growth assets is absolutely essential. There is a myth, I mean we are talking about myths, there is a myth where people tend to think that once you retire everything should come into fixed assets, whereas it is not that way. I mean you have to put your corpus together in the right way so that there is a good mix. It can also take care of the growth of the corpus and ensure that the corpus lasts for the entire lifetime.
Again, the moral here is I think starting early, because if you start early, you can invest higher amount in riskier assets, and that diversification across asset classes which we are actually talking about happens. So again, I think we come back to the same point saying that start early on your retirement so that you are able to have all the benefits of diversification, building a huge corpus, not dipping into your corpus. I think these are very critical points that you've raised, and I think that's really important. So let's just do a quick fire round, and I think your practical experience is going to be very, very useful here and giving some practical advice to our viewers. Term plan or annuity?
Term plan is great before retirement, till retirement. Annuity is wonderful to set up an income after retirement. So both products are good.
Absolutely. Equity or debt post 60?
Appropriate amount of equity is good to beat the inflation and make the corpus last longer. 40% or less in equity is what we suggest.
One financial habit to adopt by 45?
If they have not got into that habit, regular savings, say regular investments.
Most underestimated expense in retirement?
Health.
Yeah, that's a tricky one. Retirement in one word?
Energizing.
Who is your dependable partner in a dignified retired life?
My spouse.
Great. I think that's fantastic. Thank you so much, Suresh. It was a pleasure talking to you. We do a small thing with all our guests, and we have this plant on which we sign, and we kind of keep it on our wall here. So I'll just sign it and share it with you. Request you to please sign on this.
Thank you. So thank you, Jyoti. It was wonderful doing this podcast with you. This is a very, very important topic, retirement. I hope our viewers, our guests would have got a lot of takeaways from this. Incidentally, I have also written a book called If God Was Your Financial Planner.
Oh, fantastic.
And in this also I am covering retirement planning. I think it will be interesting for you to go through. Since we have had this podcast, I think it will be very interesting for you to go through this.
Thank you so much, Suresh. I think it's, our viewers have benefited a lot from your insights, and I'm sure this book also will give them more, insights into how to actually do their retirement planning. So thank you so much.
Thank you. Thanks a lot.
Canara HSBC Life Insurance. Promises का partner.